When you're looking at disability, this is one of the things that I really had a challenge with was there's a infinite number, seemingly limitless number of options and riders and things to like attach to this policy. In your opinion, like what are those most critical ones the doctor or nurse or dentist or somebody or pharmacist needs to make sure they're paying attention to?
So I think your own OC or regular OC definition is important. I think cost of living adjustment. You know, the pricing on these policies is very significant when we go to shorter elimination periods. So you'll see like you can go 30, 60, or 90, or 120 days. If you're, let's say, a surgeon, your hands are very important to you. You know, you break your hand, you're out for 3 months. That's a lot of earnings you lose. A dentist is the same thing. Their hands are, you know, very important in their day-to-day. You know, physicians will be the same thing, but maybe to a lesser degree than, say, a surgeon. So you want to protect, you know, those assets. The hands are worth a lot of money, and it generates your revenue. So I think that's one of the big ones. I think, again, the cost of living adjustment is an important one if you end up with a long-term disability. And I think the future purchase option, so when you graduate, you may not be earning as much as you might, say, 3, 4, 5 years down the road. Once you get yourself figured out and you have a bit more money to allocate to it, you can buy additional coverage. The nice thing about that is you don't have to go through medical underwriting. It's just financial underwriting. So you just have to prove your earnings are sufficient to cover the amount of disability coverage you're looking to have.
Yeah, you don't have to start from scratch with the policy all over again.
And again, I just love both for, you know, disability and critical illness. I think it's a great return of premium feature. It's opportunity cost. It gives you a chance to recover some of those premiums back, and I just look at it as it can go into your savings accounts. And when you deal with, say, critical illness insurance for that matter, it comes at age 65. You just roll it into your investment portfolio if you haven't had to claim. And if you haven't had to claim, you're fortunate, right? You've protected yourself from, you know, having to miss a year out of work because you're recovering from something that, you know, obviously we come across all the time. You ask, you know, 100 people to stand up. There might only be 3 or 4 people standing up who don't have someone that they know in their life who's either had a heart attack, stroke, or cancer as the big 3, right? So.
Good to stay protected. Yeah, I mean, especially when you think you're one ski injury away from being out for however many months.
I think the other thing is as we get older, it's really interesting the way it works with underwriting. You know, the more informed you are about your health, the more of a medical records there are, sometimes it's almost harder to get.
The more negligent you are, the easier it is.
Sometimes it feels that way, right? Because there's more of a history there that they can go off of. So when you have been going to take care of yourself, it gets documented. A perfect example is when I bought my own disability policy. I had been working out with a trainer doing some wall balls. My pelvis went out, but I thought it was my knee. I spent $2,000 on physio, didn't really fix the problem. Chiropractor fixes it. I have an exclusion on my disability policy that, you know, it's not going to pay if I have a knee injury. Now, I don't know how that really impacts me in my day-to-day job, but there's a perfect example of how these exclusions can creep up. So it's one of those things to be mindful of. I think the other thing when we're talking about insurance, life insurance is one of those things where this one bugs me a little bit in the industry is, you know, we're asking people to talk about their mental health, but if you have a documented mental health history, a lot of people are declined because they're viewed as a risk of, you know, potentially suicide. And it becomes one of those major issues that young families who might be coping and people might be dealing with their mental health issues, but they aren't able to get insurance and protect their family. So
it's sort of the sad reality of the situation. I don't know if there's much that the planner has to do on that side. It's more of just like the negative side of the insurance industry.
What I would say is the older we get, the more we become aware of underlying health issues. Before you have kids, for women, you know, you can do things. My kids were all insured when they were babies, and they don't have these policies anymore. At least I haven't seen any in a long time that had this guaranteed insurability, so they don't have to go through the whole medical underwriting. They have up to, I think, age 30. I have to check the policies. It's been nearly 20 years since we bought them, but you know, we have that insurability protected for our kids, and it was one of those things where it's handy to have. So I think when you're young, buy the term insurance. It's cheap. You can always convert it later on. I think for physicians, if you're not incorporated yet, one of the things to think about is you can buy the policy that you might want to own in your corporation. You can transfer it to the corporation tax-free, but you can't do the opposite. So it's, you can buy with the intent of when you do get incorporated, if you're not incorporated yet, you can move it to your corporation afterwards and have the corporation pay premiums. It's not deductible, but you're still using, dollars that are taxed at 11% versus whatever your tax rate is on your personal side.
And then term versus whole life. Now, the mantra I've been taught is that, when you're younger, term is probably the way to go. I think that's what I've got set up on currently. What are your thoughts there?
Yeah, so I think term is really your rental. It's your lowest cost solution, and it can be very affordable at various stages in life. I think physicians are a bit unique where you don't have that ramp up in terms of career income. Like everyone else will take maybe 10 or 15 years to kind of get to higher income levels where when you finish you're going to get there fairly quick. So I think getting the term insurance as early as possible, protecting your insurability is never a bad thing. What I would say is the conversion part, I like to make sure that you've checked off some boxes first, because you can spend a lot of money on different types of insurance. And what you want to make sure is that the insurance isn't coming at the expense of your other goals. And you want to strike that balance, because you'll have lots of people, well, you should buy this huge whole life policy. Yeah, it will work and it will do what they probably are saying it will do. But if you don't have a large investment portfolio yet and you're strapping your cash flow, it doesn't make sense. You start to get $1 million, $2 million built up in your professional corp, it's a bit easier to kind of think about it, I think, and consider it.
Is there ever really a role for whole life insurance early career, or is it very much just used as like an investment vehicle later stage?
No, I think you can do it. I just don't think it should be disproportionately large. I think you want to make sure you're balancing off your other goals, debt payments, buying your first home, all those kind of key things that you're maybe dealing with when you first finish and get back or into the workforce. Okay, so maybe. Yeah, like I wouldn't, it just comes down to the size. I mean, you can see policies where people are putting $100,000 a year in. Is that appropriate for someone who doesn't have any or minimal investments yet and doesn't have a home? No. So we want to, it's striking that balance. What's the goal that you're trying to achieve? Maybe it's just final costs that you're trying to deal with on the personal side. So you go buy a $100,000 whole life policy that, when you're young, it's not that expensive, and it kind of builds that baseline permanent insurance that you'll have, and then you can look at transferring your term insurance or putting some insurance in your PC later on.
And then critical illness.
Yeah.
I can't remember if I have this one or not. What's the difference between that and short term? Or term, sorry.
Well, so really what you think about is term is life insurance, and it's dealing with you when you're gone, so you're not going to benefit from this. It's protecting spouses or family, et cetera, or covering debts. When it comes to disability and critical illness,
okay, so it's part of that side.
You're on the living benefit side, so as in you haven't died. Now you're trying to protect your own financial situation. So disability obviously replaces income while you're disabled, so it doesn't impact your ability to pay mortgages, that kind of stuff, and make sure you're keeping your financial picture in good shape. I think critical illness comes into play. When you think about it, the odds that one of us or 1 in 3 or whatever are going to have some sort of major critical illness before we're 65 years old, that impacts your financial planning.
Yeah.
If you were given the choice of tap into your investment portfolio or have a critical illness policy that can pay out to help pay for, say, a special drug that's maybe not covered by AHS, what are you going to do? Well, you're always going to pick, I want to live over not live. So if it means paying money to get the help or the health care that you need, you're going to do it. That's not to say that our system's bad. It just says there's not always, certain drugs aren't approved. And so if you need a certain drug, then you want to get that. If you want to go get a certain procedure that maybe isn't available in Canada, you have those choices, and you don't want to ruin your financial planning or your retirement So that's where it kind of comes in.
So what does it actually get you, given that we live in Canada and skin and bones heal for free for the most part? What's the difference? It's just for like those fancier treatments or really like cutting edge procedures?
Yeah, certain things that aren't just covered by our system, right? So, yes, we all have access to the basics, and there'll be approved, medications or therapies for whatever illness you might have, but there might be ones that have yet to be, validated in Canada or approved in Canada for use or covered by our healthcare system, so you can access it without, having to ruin your bank account or your corporate.
Okay, so you've got your disability. That's like if you get hurt or sick or whatever happens, and that like pays the bills in the interim. Then you've got your life insurance, either term or whole life, and your term is like your rental car insurance, good for the short term, get you going when you're early stage. Whole life is much more the longer term, creating transfer of wealth generationally.
I'm Dr. Jordan Vollrath, and you've been watching Cherry Live, brought to you by Cherry Health. Please like and subscribe to see more clips like this, or check us out at www.cherry.health, Canada's medical network.